Bernie Madoff was at the height of his success, living a lavish lifestyle filled with luxury homes, yachts, and exclusive social circles when everything came crashing down. Madoff owned multiple properties, including a $7 million penthouse in Manhattan, a $4 million mansion in Palm Beach, and a $3 million home in Montauk. His Palm Beach estate was a stunning oceanfront property, featuring high-end furnishings, a private pool, and a perfectly manicured lawn designed for extravagant gatherings. He also owned a luxurious property in the south of France, where he would retreat for exclusive vacations. Beyond real estate, Madoff indulged in high-end automobiles, including a collection of Bentleys, Mercedes-Benzes, and a custom-made yacht named Bull. The 55-foot yacht, stationed in the French Riviera, was a symbol of his wealth and exclusivity. He frequently entertained wealthy investors, celebrities, and politicians aboard, hosting extravagant parties with the finest champagne, caviar, and gourmet cuisine prepared by private chefs. Madoff and his wife Ruth were known for their extravagant shopping sprees. Ruth reportedly spent hundreds of thousands of dollars on designer clothing, jewelry, and accessories from brands like Chanel, Cartier, and Hermes. They dined at Michelin-starred restaurants, spending thousands on exclusive wine collections and delicacies. The couple also traveled in private jets, enjoying vacations at the world's most luxurious resorts and islands, where they were treated like royalty. Despite the appearance of limitless wealth, all of it was built on deception. In December 2008, he was arrested for orchestrating the largest Ponzi scheme in history, stealing $65 billion from investors. This single event rocked Wall Street, devastated thousands of lives, and changed financial regulations forever. But how did this happen? How did one man fool so many people for so long? To understand the story of Bernie Madoff, we need to start with the basics. A Ponzi scheme is a fraudulent investment operation that promises high returns with little or no risk. But instead of generating legitimate profits, it uses money from new investors to pay earlier ones. It begins with enticing promises of unusually high and consistent returns, often backed by claims of a secret investment strategy or exclusive opportunities. Early investors receive payouts, creating the illusion of legitimacy and encouraging word-of-mouth recruitment. As more investors join, the scheme appears successful, often supported by fabricated financial statements. However, it can only survive as long as new investments exceed withdrawals. Eventually, when too many investors attempt to cash out or new investments slow down, the scheme collapses due to a lack of real profits, leaving later investors with massive losses. Bernard Lawrence Madoff, often called Bernie, started his career in the financial world in the 1970s. He founded Bernard L. Madoff Investment Securities, LLC, a legitimate trading business, and built a reputation for success. Over the years, he became a well-known figure in finance. Madoff's firm was respected, even serving as a chairman of the NASDAQ stock exchange at one point. Madoff's image was that of a trustworthy, experienced, and innovative financial expert. This reputation was key to his scheme. People believed in him. They trusted him. They wanted to invest with him. And this is how the fraud started. Madoff offered consistent and high returns, even during times when the market was struggling. This seemed too good to be true, and it was. Behind the scenes, there was no magic formula or complex investment strategy. Instead, Madoff used the money from new investors to pay returns to older investors. The rest of the money went to his own pockets or was used to fund the luxurious lifestyles of himself and his family. To keep the scheme going, Madoff used secrecy and exclusivity. His fund was not openly advertised. Instead, it was presented as an exclusive opportunity. This made it even more desirable. People believed they were lucky to be part of it, Madoff also claimed to use a split-strike conversion strategy, a legitimate-sounding investment method. Few questioned him, and those who did were often ignored or dismissed. Madoff's success also relied on connections. His clients included wealthy individuals, celebrities, charities, and even financial institutions. Many of these investors didn't just invest their own money. They brought in others, further feeding the scheme. The more people trusted him, the more money poured in. Madoff's scheme lasted for decades, but there were warning signs along the way. Some experts noticed that his returns were unusually consistent, even during market downturns. Others pointed out that his methods were not transparent. A financial analyst named Harry Markopolos repeatedly raised concerns, submitting detailed reports to regulators. He even described Madoff's operation as a Ponzi scheme years before it collapsed, but his warnings were ignored. Markopolos' efforts are a story of frustration and perseverance. He spent nearly a decade trying to convince the U.S. Securities and Exchange Commission, SEC, to investigate Madoff more thoroughly. Despite presenting mathematical evidence and detailed analyses, his concerns fell on deaf ears. Markopolos later described his experience as shouting into the void, highlighting a systemic failure in financial oversight. The failure of regulators to act on these warnings has been widely criticized. The SEC investigated Madoff multiple times, but failed to uncover the fraud. This raised questions about the effectiveness of financial oversight and led to significant reforms after Madoff's arrest. The global financial crisis of 2008 played a crucial role in exposing Bernard Madoff's massive Ponzi scheme, which had operated undetected for decades. As financial markets plummeted and economic uncertainty spread, many of Madoff's investors, fearing further losses, sought to withdraw their funds. This sudden surge in redemption requests created a severe liquidity crisis for Madoff's firm. Unlike legitimate investment operations that generate returns through real market activity, Madoff's fund relied entirely on new investor deposits to pay earlier investors. When fresh capital stopped flowing in, the entire fraudulent structure crumbled. The illusion of consistent high returns that had convinced so many people to entrust him with their money could no longer be maintained. On December 10, 2008, faced with no way to cover the growing withdrawal demands, Madoff finally admitted to his two sons, Mark and Andrew, that his entire investment business was a sham. He revealed that it was one big lie and that there was no actual trading taking place. The next day, his sons, who had no prior knowledge of the fraud, reported their father to federal authorities. Shortly after, Madoff was arrested, bringing an abrupt end to what is considered the largest financial fraud in history. The revelation of Madoff's deception sent shockwaves throughout the global financial industry. Investors, including high-profile individuals, charitable organizations, banks, and hedge funds, suffered catastrophic losses, collectively amounting to an estimated $65 billion. In 2009, Madoff pleaded guilty to 11 federal crimes, including securities fraud, wire fraud, and money laundering. He was sentenced to 150 years in prison, the maximum penalty allowed. Madoff's family also faced consequences. His wife Ruth claimed she knew nothing about the scheme, but agreed to forfeit much of their wealth. Madoff's two sons, who worked in his firm, faced intense public scrutiny. Tragically, one of his sons, Mark, took his own life 2 years after Madoff's arrest. The other son, Andrew, died of cancer in 2014. Efforts to recover money for Madoff's victims have been ongoing. A court-appointed trustee, Irving Picard, was tasked with clawing back funds from those who benefited from the scheme. Over $14 billion has been recovered so far, a significant amount, but far less than the $65 billion that was lost. The legal battles have been complex and lengthy. Some investors who withdrew money before the scheme collapsed were sued to recover those funds, even if they were unaware of the fraud. This process, known as clawback litigation, has been controversial but necessary to compensate victims.